Welcome to On the Mark. I'm your host, Howard Mark Rubin. I am so excited to present this podcast series addressing our rapidly changing world and how it is affecting industries and people in unique and interesting ways. As John F. Kennedy once said, change is the law of life, and those who look only to the past or present are certain to miss the future. The business leaders and personalities who I will be interviewing in these podcasts certainly look to the future. And I hope you come away with information and inspiration that helps you adapt in both your business and personal lives. You can find these podcasts on all major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, getsplatzer.com. Welcome to another edition of On the Mark. Today we have a very special guest, a legend in the commercial lending industry, Bob Grbic, who for many years was the president and CEO of White Oak, and previously many other companies which we're going to discuss. He's actually in the Secured Lenders Hall of Fame. I've always wanted to be in a Hall of Fame. I would have preferred baseball. Secured lenders would not be the one I would pick, but Bob.
I agree with you, Howard. And first of all, thank you for inviting me. It's a great honor to be with you.
Okay, well, Bob, we're going to be talking about today the commercial lending industry, where it's going, how it's changed, and we're also going to talk a lot about management, because you've been an upper-level management person most of your career. You've dealt with customers and clients. You've dealt with managing large staffs of people. And one of the things we like to discuss in these podcasts is how, since first we had COVID and now we have the invert AI, and how people are reacting and how the changes, how we do business are expected by all these things. So these are all things that we're going to discuss today. But first, why don't you tell us what you're doing now? I know you're the CEO of Bearbrook Corporate Advisors.
Yeah, it's a great honor being a one-man show. So it's
so who do you manage?
Basically myself.
Okay.
But
you're doing a good job with that?
Doing a great job.
Okay, good.
Haven't gotten fired yet.
Okay.
But just for the record, Bearbrook Corporate Advisors is just that. It's an advisory firm. I typically work for people I know with their referrals. I want to add value to any project I take on. If I can't, I will refer that client to someone that I think can give them more value. I'm not interested in relationships just having someone to bill. This is more like a passion for me than a business that I need to do. So I can be selective, which is a pleasure, because once again, I'm not working for a paycheck. I like to have some fun and contribute and help my friends. And a lot of times my work is just a phone call and saying, what you're doing is right, fine tune it, or you need to talk to someone that's going to give you some heavy lifting capacity because you're going in the wrong direction. And ultimately, sometimes it ends up that we need to find a new lender for whatever reason. The bank or the lender can't provide what you need, and you need to get a lender that understands your business. So all those things are encompassed. So I'm having a lot of fun right now. I'm very busy. Hopefully it slows down, but I'm not complaining.
I think that in your industry and in my industry, almost any, I would call it service industry, your connections and your network is what's important, because that's what clients need. That's what clients want. If a client comes to you and you know the right person to go to, well, that's everything. It doesn't matter how much time you spent, because you're able to provide that value added to that person just from your connections, and you got a lifetime of those connections.
And that's the real value of engaging with someone like me or you. Sometimes you'll get a matter and you'll say, call someone, and they call back and say, oh, that's wonderful, you fixed the problem. How do you know to do this? Well, after 40 years working in the industry, you know what solutions work and what don't. You know what the risks are, and you know who to call that can best solve the client's problems. And the key word is solve. In my whole lending career, I had a lot of advisors or accountants or lawyers call up and say, I have this client that needs X, Y, and Z. Now, a lot of times, most of the times, I couldn't help them. But I would tell them, call one of my friends who's another lender, because they specialize in that industry. So I think if you're in the industry a long time and you have good contacts, that really helps you solve a lot of problems whether it's through yourself or putting the right people together.
Now, I know one area that you've done some work in is companies that have succession issues, succession planning issues. Maybe some partners aren't getting along. Maybe they brought their kids into the business and there are problems. How would you get involved in those type of situations, and what are the possible ways that companies can deal with those situations?
Well, to begin with, it's always an issue when you have a management team that's family owned and families in key positions. A lot of times, internal fighting or disagreements. Management's not paying attention to critical issues like what's going on with revenue, what's going on with gross margins, where's our liquidity going, and the tendency of bloated overheads. Well, your son's in the business, I have to put my two kids in. Who's making more money? So those are issues that very often cripple companies, and family succession is a key issue. And a lot of times it's solved with a leverage recap. The company's doing well, you go to a lender and figure out, okay, this company can support this dead loan, like an ESOP, and they say, we're going to pay this guy out. We'll just make a loan to the company and say you have enough liquidity to buy these people out. Obviously, those situations involve good legal talent like yourself, a tax advisor as well. But you structure something that would give the dissenting members the opportunity to leave. One time I was involved in restructuring for a company that was started in 1865, and it's really a quasi-public company because you had 300 stockholders. And fortunately, a couple of them controlled the bulk of the stock. The company was distressed, and that had to be managed out. Where part of the restructuring was a lot of these stockholders went away. So it's always an issue. The best way to avoid it, quite frankly, if you have a family-owned company, is to have independent directors. That someone will say, well, this son is going to make a bonus of X, the other son will make half, because this is what we think the contributions are, and to have clearly defined roles. But I would say you need to deal with family dissent quicker because it manifests itself into bigger problems along the way.
And let's talk about the management of people themselves. I find that there are generational issues. Before COVID, when I wanted to hire somebody, the first questions they would ask me is they'd want to know how much am I going to make, and what's my chances of becoming a partner or moving up in the company. After COVID, the first question I'm usually asked is, well, how many days a week do I got to come into the office? They don't seem to have, and I'm generalizing now, not everyone,
Right.
they don't seem to have, a lot of them, the same motivation to succeed in terms of moving up in a company or making more money. They're more interested in a lifestyle change. Do you find that that's a problem in industry today, that people don't have the motivation to try to move up in a company? They're more interested in having a lifestyle that's more conductive to family life?
I think that's a trend of entitlement where, you hear that work balance thrown it back quite a bit. And listen, that's important. You need to respect people's time. I had a rule that unless I was going to lose money or an opportunity, don't text or call me after 5 or on the weekends, with two exceptions. Am I going to lose money or an opportunity? Then you can call me at 3 o'clock in the morning. Other than that, you go home, you enjoy your family, your friends, go out bar hopping, whatever you want to do. But work is work. And I think part of the problem that people have to understand, if you want to get ahead in management, you need to involve yourself in the corporate culture. Being on a Zoom call doesn't effectively give you the opportunity to network with other parts of the company. You also don't get a sense of the politics of the company. Now, people say there should be no politics, but that's life. You want to be engaged with management. So if you just want to go to 9 to 5, and so, 1 day a week, or not come in the office at all, you're not going to get very far. I mean, look, there are always exceptions. If you're a brain surgeon or a tax lawyer, where you actually know how to get things done, you're immersing in the books and the code. But if you're involved in our professions, legal or lending or consulting, you need to be actively engaged, and the people that work for you need to be engaged. You look at companies that are successful over the long term, it involves culture. And culture is only developed by human interaction and meeting with people and discussing what's going on in production, what's going on in sales. Now, with that said, I don't think we have to do 9 to 5, 5 days a week. But I do think when I was my last management job, I had people come in 3 days a week. Mondays and Thursdays were mandatory. Friday, if you work from home, you picked another day, Tuesday or Wednesday. But I found it's very important to have everybody in the office at the same time so you can meld together and find out what's going on. And if you don't have that, if you're in on Wednesdays and Thursdays, everybody else is coming on Mondays and Tuesdays, it doesn't really work. So you need to have that culture of coming in and melding together. And by the way, if you're a young person, if you're coming in, make sure your people that you work with know you're there. Because a lot of times the world's still ruled by perception. If people see you, you walk into your boss's office and say, "Hey, Bob, good morning. What's going on?" And one of the big things I always enjoyed in any position is a good debate with my employees. And I had a policy behind closed doors, there's no privilege or rank. I want to hear what you want to tell me. If you think I'm wrong, tell me. I want to know. Sometimes you can change my mind. Not very often, but sometimes you could. I can learn from you. It gave me a great opportunity to look at people and say, this guy's got talent. This other person's just nodding their head.
See, I disagree with you about one thing that you said.
Only
And
one?
I find it very frustrating. If I want to train somebody to move up or to teach them what I'm doing, I need them there 5 days a week. I understand when we had a pandemic, people were coming in 3 days a week, and it became comfortable to come in 3 days a week. But I find that the trend now is you're finding more and more companies, and sometimes clients. I know some major banks have now told their lawyers, "I don't want to work with lawyers who are remote. I want them to be in the office. I'm not paying for remote work." And I think it's become important to push back on this culture of coming in to work 3 days a week. And we've got to get people back in the office 5 days a week. Otherwise, we don't need the people. We can get AI to replace them and do this.
I don't disagree with you, but you're looking at someone that you're training to be a lawyer and thinking once you get to a certain point in your career where you know what's going on, you are a good lawyer and you can work a day or two at home. I don't have a problem with that. But for someone that's coming into the industry as a trainee, you're 100% right. They should be there 9 to 5. Every day the office is open, learning what's going on and sitting in those meetings. Like we would always invite trainees to come into like a loan committee meeting. Every underwriting, you get a copy. I want you to read it. I want you to come in my office and talk about it. But you also have to recognize there's still a market for talented people.
Yeah, but Bob, this is what I think you're ignoring, and I know that you do this. A big function of any service industry, whether it's your industry, my industry, is bringing in business, is what I call rainmaking, whatever it
Yeah.
is. And if you want to be a commercial lender, you don't sit on your Zoom trying to get business. That's not how you got business. That's not how I get business.
Mhm.
You have to be out there with people, meeting them in person, developing personal relationships, because your business, just like my business, is built on personal relationships. And you can't build these personal relationships by Zoom. Now, you may be able to. You may be able to become a good lawyer or a good commercial lender by doing this on Zoom, and you know everything about commercial lending. But that doesn't mean that you can be the guy that does what Bob Grbic did all these years and brought in all this business and was able to take that part of the business, which is a critical part of the business. It's wonderful being a great technician,
Yeah.
but that's not enough.
But once again, you got to go back. Not everybody is a rainmaker. And if you want to develop rainmakers, you've got people tag along. I just think you have to recognize that some people who are truly talented have other opportunities. So what I like to tell everybody, you need to work 9 to 5, Monday through Friday. you have to recognize where the market is, because you don't want to lose someone because I want to work at home Friday. But on the other hand, once again, if you really want to be successful and you're 25 years old and you live in Manhattan and on the Upper East Side and your office is on 34th Street, then you should get your ass in every day in your office and make it a point of meeting everybody. But once again, if you're running a company and you have different talent pools, you have to recognize the fact that if someone that's talented and has relationship with my clients wants to walk out the door, I have a bigger problem. I have a much bigger problem. First of all, that person knows my portfolio. Now they're gone. My competitor has them, which is also a disadvantage. I could lose relationships. But to your point, every situation is different. I totally agree that if you have someone that's starting out or someone that's not cutting it, that you're saying, maybe this kid's smart. He went to Harvard Law School, but he doesn't get it. I got to bring him into your office and kind of straighten him out a little bit. Yeah. But I think you have to recognize there's a balance of talent. And I do agree. When I was coming in, I wanted everybody to be in the office on those 2 days. I also didn't want to give anyone the opportunity to have, let's say, more than 3 days out of the office, because that's why I said Monday is a firm day. So you get this mentality of, I'm going to be in Florida. I'm flying out Thursday. I'll be back Tuesday morning. To me, it's not conducive for getting your mindset into jumping into work. So I don't think we're disagreeing. I'm just looking on being more selective and how you mandate that. But I do think you need to be in the office the majority of the time, everybody at the same time. And as a manager, you need to also take advantage of that, like I was doing, saying, come to my office, let's talk about this deal. And Howard, great points. I didn't know about that. Joe, I know what you're talking about. And as a manager, you're looking at talent and saying, this guy's promotable. He can have my job. This guy, he's a journeyman. He's not going to go anywhere. It's important, but he ain't going to have my job. So that's the way I look at it. I'm a little bit more flexible, but I do understand what Chase is doing, what Goldman Sachs is doing, because at the end of the day, culture is what makes companies successful, right? Your company has a culture. My company, when I was there, I had my own culture mandates, what I expected from people. So every company has a culture, and by the way, the thing about culture is when I had these closed door meetings, or you had Goldman Sachs meeting in a boardroom, there could be dissent. But once that door opens, there's only one opinion. And that's the important thing about culture. The problem you have is someone says, well, Bob won't give you this, implying that you would. No, we won't give you this, or we'll give you X. Or you get the point, is you speak with one voice. And I think that's important to develop culture.
So do you find there's a change? I'm finding that the coming back into the office has become a trend. People are now realizing that they can't do all of this remote stuff. And I find that more and more companies are requiring people in the office.
100%.
It's going back to the way it was. I mean, would have you thought when you were coming up in your business that you could come into the office 2 to 3 days a week?
No, that wasn't even thought of. It's you coming in 2 days a week like you needed a doctor's note, right? You had to be in your office and you learned. And I used to love coming in your office, because as a younger man, you would come in your office and say, oh, I didn't know that. Let me go to this meeting. Let me go to that loan committee meeting. You will learn so much, but it is a trend. And as you know, unemployment is increasing. Employees have less options. And I think part of that is that overhead got to be bloated during COVID. People were about losing employees all the time. So they were very lax on what they expected, or looser, maybe a better word, what they expected. And now companies are looking at overheads and saying, you know what, before I always had like one extra player on the bench in case someone left. Now they're coming along, especially with AI, and saying, well, I don't need 5 people in accounting. I can do it 3. And that's where you're seeing a rise in unemployment. You're going to have some structural changes there where AI becomes more prevalent in the marketplaces, in banking and legal, and across the board. So I think it's a wake-up call. And if you have someone coming in and telling the first question to beginning this conversation was, well, how many days you have to come in the office? It's like, not interested.
Well, that would have been that was my answer beforehand. But you mentioned AI, and I want to touch on that a little bit. It seems in terms of how many people we need to do a lot of the tasks that we're doing, a lot of industries such as the taxi industry, if we're going to have robo
Yeah.
taxis, or we're doing calculations. We don't need actuaries, I would think, in the same amount of people because AI could do a lot of that work.
Mhm.
It affects lawyers in terms of
Mhm.
research, in terms
Right.
of particularly document
Right.
review.
Right.
How it
100%.
affects your the commercial lending industry and how they're doing an evaluation of a loan. How many people do you need to actually do the evaluation? Is there going to be a need for as many people for a company that's in the commercial lending space as they had in the
Well,
past?
I think as productivity comes into play, right? No, look, initially you have to worry about, is it a closed open AI system where you're getting the information, but you can, as an initial underwriting, tell AI, tell me about this industry. A lot of times when you're doing an ABL deal, and the first thing you do is you got to underwrite the industry. Where are you standing? What are the changes in the business models going on? AI can give you a pretty broad sketch, which is a good basis to start underwriting. But where it becomes more powerful is in the analytics of numbers. Like right now, you'll have analysts analyzing financial statements. You also have sensitivities of projections. And you can just imagine AI can do this in seconds, where you can say, well, here's a projection, assume the gross margin drops by 2%. Interest rates go up by 1%. The AR turns 10 days slower. Does this company still availability? Does it still make money? So it's a great tool. I was listening to one speaker about a year ago, and they did a challenge between an AI model and Bloomberg analyst, and the AI model did a better job, apparently.
So does that mean that in the future, we'll talk about the commercial lending industry, but it's true for any
Right.
industry. But in the commercial lending industry, we're going to need less analysts.
You
We're
will.
going to need less people to do that job. So then I would think that the employee wouldn't have the same leverage about not coming into the office, because either you're going to come into the office, or a lot of what you're doing remotely for remote work, I can use AI. I need people in the office to do that personal contact, that personal going out to lunch or finding out what the client needs, and that you can't do with AI. So I would think you have people coming in. The leverage is going to be, the balance is going to be on the employer, is going to force these people to come in.
The few people that, I don't know about that. Once again, I'll make the comment again. There's always exception. Talented employees always have a place to go if they want something, right? So you've got to keep that in mind. You wouldn't be fair to everybody. You don't want to say, well, this guy can come in, this guy can't. So but when you have a training program, you can define that what you want in your firm. Maybe it's the first 5 years you're an associate, and you come every day. And you're always going to need people. For example, AI can do all the analytics, but when you're in the industry for a few years, I call it's like the Buddha bell. You know something, you look at it and say, it doesn't make any sense, or that legal structure doesn't even make any sense. So you can look at all this stuff and say, you're right, AI will change the whole world. There'll be structural unemployment. People will be dropping out because they'll be fired and they got to find new careers. But I still think you're going to need people. Those people that you need will be more valuable. And your overhead levels will change dramatically in these companies. Yes.
One thing I know that you're not really in the traditional banking industry, you're more in the alternative lending industry. But I found the evolution of banks to be fascinating. When I had my daughter's wedding at Capital, which used to be the headquarters of Dime Bank in Lower Manhattan, and it was an opulent, gorgeous structure. Banks in the turn of the
So you're working a
century.
second job to pay that off, right?
That's why I'm doing the podcast.
Okay.
So they were opulent. Banks were opulent. Then they became not so opulent. They became more. We have as many small little offices around. Now banks are going to a structure where they hardly have any offices at all. People don't go into banks anymore, and they just have ATMs. And now the ATMs are going away because people can use their cell phones to do most of their banking.
Yeah.
Is that a trend that you see in the banking industry, and how it's so dramatically has changed in the last few years?
It's changed dramatically, and you have a consolidation of most of the banking done by a few large banks, whether it's J.P. Morgan or Wells Fargo, Bank of America, Capital One. So it is changing. There are still a lot of smaller banks out there, and PNC just acquired one bank, I think, on the West Coast. So there's a lot of changes going on, and I think with the current regulatory environment, may see more of these type of mergers. But the banking industry is governed by regulations, and a lot of the lending policies are governed by regulations. And let's face it, after or during the Great Recessions, banks were looking for the door in a lot of loans, and that's when you saw a boom. I mean, the non-bank market has always existed. You have companies that have been around for 80 years, 90 years, 100 years that have been private lenders, but that's really increased dramatically. And it was also giving a huge boost during COVID when banks were also looking for the door. And I think the non-bank market now is well over $1 trillion. And keep in mind, the non-bank market uses bank money because they leverage their capital. But the banks feel more comfortable lending to non-banks because of the equity the non-banks have to back up the loans they wouldn't make.
I'm finding more that banks, when I have clients that want a loan, the first question I get asked by a bank is, well, will they move their deposit relationship to the bank? And frankly, the loans are almost like is something they'll do as an add-on service if they're getting enough in deposits. And if I really want to get a competitive rate for a client in for a loan, I'm going more and more to the alternative banking sources and not the major banks.
Yeah, banks like deposits because they can leverage them with the Fed, right? So they want bank deposits. It's a great yield as well because I think Chase was paying you like a couple of basis points of your deposit, and they're lending at a SOFR plus 2 or 3. So yes, they love deposits, and keep in mind when they're financing a non-bank lender, right? They don't have as much risk. Assuming the non-bank lender has a diversified, well-managed portfolio, they don't have as much risk, but they get all the deposits. So it's a bonanza. Even though a lot of people say that could be the next banking crisis, I don't know if that's true or not, unless you have a prolonged recession. So I think you're right, and quite frankly, the spread the non-banks have been charging is getting smaller compared to the banks because there's so many non-bank lenders now. I think the non-bank market grew 20% last year, so the differential for a corporate loan can only be 200 or 300 basis points from a bank. So you're having that also makes it more lucrative. But I think it's also important to note that for the banks, the non-banks are the best place for a workout officer because if you have a problem loan, what do?
Right.
Call up these 5 non-banks, I'll make you a bid on your offer. So it's great for the banks in a lot of ways. All understanding there's some inherent embedded risk in lending to non-banks, but I think that's diversified if they're managing their book right and they have a diversified portfolio. And banks are not stupid. Let's face it. Some of these banks are extremely well managed. But you're right. The banking markets change, and someone once told me they're becoming more utilities than they are what we traditionally looked at. Go to a bank and get money.
And let's talk about a subset of the non-banking industry, the factoring industries. I know you have
I know a lot about factoring. Yeah,
about factoring. It's an area that specifically factoring. And maybe you can explain for people that don't know what factor does and how has that changed in the last few years.
Well, factoring is essentially the first form of ABL. Before you had ABL, you had factoring, which means someone was buying the receivable and giving you the money up front. A lot of times that was called discount factoring. There are a lot of forms in factoring, but the simple matter is I'm buying the receivable and giving you money. And
is it on a recourse basis?
It could be both, but initially you were taking the credit risk, right? So the factor provided a service too because there's your back office for credit. cash applications.
Right.
They would make collection calls. And you got to keep in mind, factoring was very powerful. And initially, the colonies were using factors to finance their trade with England.
Right.
Because you didn't have a codified UCC.
You weren't involved in that, though.
I'm not that old.
You're not that old.
But you didn't have a codified UCC code that could say, this is my collateral. So you actually had to own something. I own that receivable. You owe me the money. And over the years, as ABL has grown, you had a UCC code.
Right.
That the factoring book has gotten to be smaller in terms of the industry. It's still big, but the European factoring market is much bigger because they don't have a UCC code like we do that covers all of the EU. Maybe one day they will, but factoring is more prevalent in Europe, for example, than it is the US. So factoring still exists. It's a quick way to delever as well and get quick cash. A lot of large companies use factoring because it's technically not considered debt, depending on how you structure it. You're getting into a true sale opinion, which I'm sure you'll love to give an opinion on. But it's not really on the balance sheet. If I bought the receivable and gave you money, I have the loan against the receivable technically because I bought it. So a lot of companies use that to manage their covenants in a higher level market. But in a pure sense, if you're starting a company that's selling, let's say Costco, and you want your money the day you ship the goods, factoring is a great tool to get started both on a recourse, non-recourse, O-line discount basis.
Is factoring shrinking? Is there less in the United States? Is factoring shrinking for instead of other types of alternative factoring?
I think
Factoring is kind of expensive, isn't it, for a company if they're doing their receivables?
Yes and no. I think most factors, if you look at the large factors, and White Oak Commercial Finance is one, CIT, Wells Fargo,
Rosenthal,
which has been around for like 85 years,
right.
Milberg, well-regarded old factor. Those are what I call the main factors. You have other factors that are in there as well as merchants. And then you have a whole smattering of smaller recourse factors, and there's hundreds of them that operate very smallly. The larger factors are going to be not as expensive considering they're also a service provider.
Right.
So I think if you look at it that way, I know some companies that are very large still use a factor because they like the service aspect of it. And it's easy to use once you get involved in the systems and setup. So I think factoring is still a very powerful tool. It's not as popular as ABL because you don't have to pay the commission, but you're getting the benefit of someone looking at the credit, collecting the money for you, what have you. But there are different forms of factoring we can talk hours about. Non-notification factoring.
Let me ask something else. Is the factoring industry, because a lot of it, it's not totally in the apparel industry, but a large part of the factoring industry deals with apparel. How are tariffs affecting the factoring industry?
Yeah. Well, I characterize it as snap tariffs because the American entrepreneur is very resilient. He can find a solution. But when you tell someone I have orders from Walmart and all of a sudden now your cost has gone up 30%,
right,
it's a problem. And we can debate whether the tariff strategy is correct. One can argue that, we should probably have tariffs. We've been taken advantage of for long enough time for different political and economic reasons, but it would have been a lot easier to say to everybody in 9 months, these are going to be the tariffs.
Right.
And so when you can't manage your costs on your gross margin, cost of goods sold, it's a major problem. And also what you have right now is everybody's doing price discovery. Walmart's looking to replace you. You're looking to replace your vendor. And you're thinking, I got a 50-year relationship with, I'm exaggerating, with Walmart, but maybe you don't have that. The other side of it, and people don't think about this, is that why did China get to be so big as an exporter to the United States? Because when I first started, there was a letter of credit they wanted before they shipped. And over the course of the years, they became major credit extenders to importers. So you went from LC to pay me when the goods ship to pay me when the goods land to I'll give you 60 days. Now think about it. You want to move production to another country. The guy says, well, who are you, Howard? And I want LC, I want a deposit. a lot of these companies don't have the wherewithal to manage that kind of liquidity. And you also have your supplier in China saying, well, I don't know, Howard, you're going to be my customer next year. So I was giving you terms. I was letting you pay late. No more. I need the money now, or I need it quicker. So that's also creating stress when you're moving. And also keep in mind when you're moving factories like a Walmart, they're going to say, you're going to Vietnam. Is that factory been inspected by my people to make sure there's no child labor, you're not transshipping? It's not so easy for a smaller company to move. And by the way, it's not just small companies, it's any company that doesn't have a lot of liquidity or a low gross margin is being impacted. So you can have $1 billion company with a 20% gross margin, you can have a problem. So I think, all these issues right now are not manifested yet. They will be. I think a 15% a tariff is probably manageable. 5% the exporter eats, 5% you eat, 5% the retailer eats. But when you get to these tariffs of 50% on Indian goods and 30% on China, it becomes more problematic. So it's still in flux. I think a lot of people are looking at it and saying, how do I deal with this? And you'll see some repercussions of higher prices, and some of these companies will have to disappear, suppliers.
And what do you think is going to happen in the future in the next 5 or 10 years in the factoring industry? I noticed in the banking industry, a lot of foreign banks are coming into the United States. They're making acquisitions. There's a consolidation that's happening in a lot of the lending industry. Where do you see the lending industry itself, particularly the factoring industry, going in 5 to 10 years? What changes do you see?
I still see it growing, and also we have to start thinking about supply chain finance. So we just had a conference on September 8th at the SFNet, which is the industry group for asset-based lenders and factoring, about supply chain finance. And if you look at the basic level of supply chain finance, it's factoring. You're financing that supply chain early on. So the supplier in Vietnam ships the goods, you pay them early on. You pay them at the onset. So a lot of people, when you include supply chain finance, it's a really growing market. So it depends how you define it. The financial products are always changing to the needs of the consumer and the customers here. So it's a changing market, but I do think factoring is still going to be here. It's been around for a long time, and the face of it is changing. It's a good business to be in. And quite frankly, it was the first form of ABL. Before you had, give me a borrowing base, you had factors, and it goes in cycle. I think it's an interesting market. I think it's over 120, $150 billion market in the US, and it's in the trillions in Europe.
Do you see a consolidation in the market that there'll be? I know there's a few major factors, and then there's a whole bunch of small factors.
I don't see a consolidation, because you have to consider there's an aggregation of debtor risk. Mm-hmm. So how much debtor risk does one factor want to have with one customer? Right. So, if you have a $200 million line for a customer A, and I have a $200 million line for customer A, we put the two factors together, and all of a sudden it's $400 million. That doggone it's too much. So I think that's always been a deterrent for huge roll-ups in factoring.
So I know I'm not an expert in the factoring industry. My partner Howard Jaslow is,
great guy,
as you know well. Yeah. But I do know that a lot of factors will only buy the receivables from certain stores or certain vendors. Like they'll take a factoring from Kmart, but they won't take it from somebody who's the company's a little bit shaky.
Let's hope they don't take it from Kmart, because they're long gone. But
I said Kmart, I meant Walmart.
Walmart, yeah.
Walmart, not Kmart.
Well, but
that's why they don't take it from
No,
Kmart.
Exactly. But I think what you're seeing right now is a move towards recourse factoring, where most people will say either two ways. Your customer base is not warranty for me to insure it, in which case the factor will look at it and say, how diverse is your customer base? If you have one customer that makes up 8% of your book and it's not creditworthy, you probably don't want that deal. If you have 100 customers and 2 of them are shaky, you'll probably do that deal, because you're going to put it back to the client. Well, also a lot of times the the borrower, the client, doesn't want non-recourse factoring because his book is all investment grade. So he's saying, why am I paying for that right for me to put back that receivable to you if at the end of the day, I'm this investment grade. I'm not worried about not getting paid. So you have that aspect of it. So we see more non-recourse factoring.
I have a million other questions for you. I'd like to continue it, but we've kind of come to the end.
That went too
It's been
quickly. I was
fascinating.
just getting going.
Let me ask you one other question that I always had about the insuring the receivables. In other words, insurance companies will insure a receivable to a factor. Is that something you see more and more companies doing, insuring?
You do, but to keep in mind that insurance requires compliance. So if you're not complying with the terms of the policy, you're not getting paid. So do you have the current financials? Did you notice the company was past due more than X days, more than X percentage, and there's a stop shipment clause, and you continue to ship against that policy, and when it goes bad, insurance company says, no, you're not covered. So insurance is great, but you need to have someone designated in your company that you need to watch this.
So it's the old adage that when someone wants to lend you money, they want to lend it to money who don't need the money.
Listen, there are a lot of good insurance companies, and they're usually I don't know anyone that had a valid claim that didn't get paid. But I think at the end of the day, like everything else, you got to find the right people, the right lender, and consider getting good advice from people like you or me as to what's the best insurance company you can use for your situation, the best lender, the best attorney for a particular situation. So that's why we're here.
Well, Bob, I want to thank you for being on the Mark. I think it's a fascinating industry, and I think there's a lot of people that can be helped by the information that you've given us. And if you out there want information on the lending industry or management issues, Bob is a great guy to go to, and I highly recommend that you contact him.
Well, Howard, this went way too fast, and we can continue to debate.
I told you how fast it goes.
We can continue to debate about being in the office or out of the office.
Right.
We'll come back in 5 years and see who was right.
Okay. Well,
all right.
Welcome.
Thank you.
Welcome for being on the Mark.
Thank you. Thank you, Howard.
Thank you. Bye-bye.
I hope you enjoyed this episode of On the Mark. I started this podcast by quoting John F. Kennedy and would like to end it with quoting one of my favorite baseball players, Nolan Ryan. Enjoying success requires the ability to adapt. Only by being open to change will you have a true opportunity to get the most from your talent. I wish you success in staying ahead of the curve instead of behind the 8 ball. Thank you for tuning in.